How's it going, everyone? Today is going to be another macro video on what's known as the Japan yen carry trade, the yen carry trade unwinding specifically. Now, let's begin. What is the yen carry trade and the subsequent unwind? What is it referring to? So, to explain this, we have to look at a couple of specific charts and also understand some historical precedents. So, for the longest time, Japan had 0% and even below at some points interest rates. Okay. What that means in effective terms is that it was practically free to borrow money, um, and yen specifically, right? So investors all around the world saw this as a huge arbitrage opportunity. The Japanese did as well. So the mechanism is very simple. For roughly 20 to 30 years, Japan had interest rates at 0% or even negative. Okay. Meanwhile, the US and other countries had higher rates, anywhere from 5 to 10%, depending on the country, right? The US had it a little lower than other countries historically, but nonetheless, it's still much higher than the Japanese 0% interest rate. So the trade is like this: investors borrow billions of dollars in the form of yen. So they borrow billions of yen for free, effectively, because it's a 0% interest rate. Then they swap it into US dollars. Okay, so they convert the yen into USD. They can use those USD then to either buy US treasuries, which are risk free, yielding whatever the US interest rate is, or US tech stocks and equities in general, which yield you even more profit. Okay. So the result is that you effectively get free loans and money from the Bank of Japan. You borrow at 0%, you earn 5%, let's say if the US interest rate were 5, and then you pocket the difference. This is known as a carry trade. All right. It's an arbitrage opportunity between one local market and another. Okay. Japan had 0% rates, US had 5%. That's an immediate 5% profit ability in terms of the yield. Now, what happens once Japan hypothetically increases the interest rates? Well, we don't need to think hypothetically. I have the chart right here. Interest rates have been increasing in Japan, with them reaching a low of negative 0.285 twice over here at this double bottom looking formation, and have been on a steady rise since. Right now, Japan has the highest interest rates it's seen in years. This is the 10-year yield, so it's not quite the interest rate, but nonetheless, it shows you the tail end of this yen carry trade and the Bank of Japan's interest rates. So suddenly, borrowing yen isn't free anymore. It costs 0.25 or zero point 0.5, and that rate is currently rising, with the Bank of Japan scheduled to increase rates again on December 18th and 19th during their equivalent of the FOMC. Okay? This creates a currency shock because as Japanese yen rates rise, the yen gets stronger against the dollar. This proves to be very deadly for the carry trade. Now, why is that, you might ask? It's because of the agreements when investors borrowed the yen, right? So, for example, if you borrowed 1 million yen when it was worth, let's say, $5,000, but the yen strengthens, and that same loan now, because the yen, it's the underlying asset is yen, and the yen strengthens now, the same loan is worth like maybe $6,000, right? You are losing massive amounts of money on the currency exchange alone. On top of that, then, you also have rising yields, and this is a dynamic that makes it even more complicated, but even more volatile and potentially deadly for the trade as a whole. What happens after that? So step 3, we have the free money era, okay, which is investors borrowing yen at 0% for decades, roughly like 20 to 30 years. You have step 2, where the reversal occurs, where Japan finally starts increasing its interest rates because they are trying to tamper inflation in their country. And step 3 now is the unwind, okay, the panic phase. Investors realize the trade is turning against them, okay? Their costs for this loan are rising, and that is eating away at the profitability of that carry trade. They start rushing to unwind, okay? To close their loans, they effectively have to do either sell the US assets, take dollars from the sale, and then not either, but they have to sell their US assets, so either stocks and treasury bonds. They have to take dollars from the sale, and then they have to buy back the yen to pay off the Japanese loans, right? Because when they're getting that free money, it's not actually free, they're just borrowing it, and they have to pay it back at the interest rate. Well, if the interest rate is 0, it's effectively free money, but all of a sudden it's not, okay? So you see how this is a problem now, right? Because all that money that was quote unquote free is now having an increasing price tag on it. And as that price tag increases, the value in their investments, the value that their investments are providing, is no longer anywhere near as attractive as it was when the money was free. So in order to pay off their obligations and de-risk, they have to unwind. That's where the term the yen carry trade unwind happens, okay? What does this result in? Well, it results in a huge increase in supply, in selling pressure, right? And it happens in 2 distinct ways. The first is the impact on stocks, and the second is the impact on treasury yields. So the impact on stocks would be that investors, foreign investors specifically, as well as a lot of US investors, because keep in mind, by the way, right? It's 0% interest rates at the Bank of Japan are not just attractive and available for the Japanese investors, but also foreign investors, like even American investors, right? There were a lot of Americans, a lot of investors from all around the world that noticed this very obvious and attractive arbitrage and carry trade opportunity. And so they went and took on loans from the Bank of Japan and then either invested it in their home markets or just in the US market or treasury yields or treasury notes, whatever, right? So those assets now need to be dumped in order to raise cash to pay off the loans. So the result is the stock market drops. And it drops in a very rapid and fast manner. And I'll show you an example of the last time this occurred and how this can be occurring again within the next 3 weeks and how it can be even worse than the last time. But moving on. And the impact on the treasury yields is the exact same. So treasury yields across the board around the world had been increasing, right? Here's the US treasury yield. It's mainly chopping around here, forming some consolidation, but this has been a very massive rise since the 2020 lows, right? And we can expect this to continue. The 30-year is roughly the same. It's looking even more bullish, if you had to put a term on it. It's not bullish for the market in actuality, but looking at what the chart says, right? So investors have to dump US Treasury bonds then, okay? When they sell their bonds, the price goes down, which means the yield goes up. And that's exactly what we're seeing here, right? The yields, this is the 30-year yield chart, is rising. What does that mean? Well, it means that bonds are actually being dumped. The yield becomes more attractive and goes higher as a way of saying, hey, I need more money to make this an attractive investment for me. I need a better profit. I need a better yield coming out of this T-bill, okay, for me to actually go and buy this. And that's why the yields are rising, because the bonds are being dumped. Okay, so it's effectively a 4-step process, 5-step really. Okay, 1, you have the carry trade in the first place. 0% interest rates, very attractive arbitrage and carry trade opportunity. 2, you have the Bank of Japan hiking rates. Okay, that makes the yen go stronger. And 3, you have the carry trade breaking, because investors are now being squeezed on the cost of those loans that were previously free and now being forced to have larger and larger, ever increasing payments on those loans. Okay, that creates forced selling, where investors have to sell US treasuries and stocks to cover the losses, and the market as a result drops. Treasury yields rise, stocks fall. So you might say, well, that's just Japan. How important is Japan? Right? We're America. We're the best. Take a step back for a second. Do you know, well, everyone knows that the US stock market is the biggest. We have most of the top 10 companies in the world, the Fortune 500, Nvidia, Microsoft, Apple, Meta, Google, big tech, industry. We just got all the money, all the biggest banks, all the biggest tech, the biggest, the baddest, the greatest, yada, yada, yada. Do you guys realize that Japan is actually the second largest stock market in the world? Nowhere near as big as the United States, but still the second largest biggest. Do you also know that Japanese investors are the largest foreign holders of US government debt? That's right. On a country-by-country basis, Japan holds more US debt than any other country in the world. That might surprise you. That might shock you. You might think, wow, it's not the EU. It's not China. No, it's actually Japan. Okay? Because of that yen carry trade dynamic. So if they stop buying that US government debt, those bonds, or even worse, that they start selling in order to take that money back to Japan and pay off those loans, US interest rates, the yields, could spike uncontrollably. Okay? High yields, and just to clarify why rising yields are a bad thing. High yields are bad because they limit the flow of money and increase the cost to maintain loans and the cost of borrowed money in the American economy. Okay? Rising yields, the 30-year, for example, is what determines your mortgage rate. Okay? It's what determines your auto loan. It's not actually the federal interest, the FOMC set interest rate. Okay? That's the federal funds rate. It's a different thing. It makes it harder for the US government to pay its own debt interest, because anytime these yields go up, whatever amounts of money they have in these notes needs to be paid off at that rate. Okay? That debt has a yield of 4.8% and rising. That means that the US debt, whatever is on the 30-year, is going to be rising as well at that yield as it is right now. Okay? It hurts stock evaluations because companies are now worth less than when safe bonds pay, let's say, 5%, right? You're effectively getting 4.8% by just holding the US 30-year Treasury note. Okay? Now, let me show you this. This here is the US equity risk premium. Okay? It's a simple measure. It is the risk-adjusted premium of the S&P 500 the earnings yield, minus the 10-year treasury yield. Okay? It basically tells you how, how should I explain this? Is this risk that I'm taking on by buying and holding the S&P 500 better than just simply buying the 10-year treasury note? Okay? Again, adjusted for risk. And when this turns negative, it means that it's not actually worth it. For that amount of risk, it's not actually worth it. You're better off just buying treasury notes. So this dynamic really makes not just stocks unattractive, excuse me, but also makes it so that stocks have to be sold in order to pay these debt obligations off, right? So how does this tie in, and how does this scenario interact with the prospect of the Federal Reserve today on December 10th dropping interest rates? At least that's the projected decision, while the Bank of Japan on December 18th and 19th is projected to increase rates. It's a little complex, but effectively it's this. I'm expecting a bit of a short-term pump, temporary relief rally on the S&P 500 and NASDAQ. Okay, why? Because a Fed that cuts interest rates lowers the discount rate used to value future corporate profit effectively. Okay, this especially benefits high growth technology stocks like the Mag 7 that rely on high future earnings. All right, the market often takes a rate cut as a signal that the easy money environment is returning. It's just simply cheaper money that can be minted. All right, the rally would be built effectively on the hope of lowering rates into the future, especially with Hassett being expected to become the new Fed chair in May, who's a Trump lapdog and wants to bring rates all the way down to zero as close as possible. He believes the floor for rate, or the ceiling for rates, should be 2%. We are currently at 3.5. Okay, so he wants to almost have it. Now, that is the Federal Reserve's response, right? Technically, so while technically cutting rates is bullish for the market, if long-term yields rise, it actually becomes bearish because of that risk-adjusted earnings scenario, where it becomes just much more attractive to buy risk-free treasury notes than it does to buy highly risky at all-time high stock and equities, right? So now the Bank of Japan increasing rates, meanwhile, widens that gap a little bit. Okay? Because they're increasing interest rates while we are decreasing it. It effectively makes borrowing yen more expensive while USD is cheaper. Okay? And that dynamic results in the yields rising. As those yields rise, it becomes riskier and riskier to be buying equities. And it becomes safer and more attractive to be buying bonds. And on top of that, the carry trade begins to unwind. So let's look at what happened the last time the carry trade unwound. Here is the Nikkei, I don't know how to pronounce it. Japan 225 daily, okay, a Japanese ETF, and the S&P 500 SPY. Okay, let's look back to Thursday, August 1st, where the Bank of Japan officially started ending its negative interest rate policy and officially embarked on a rising interest rate policy. Okay, right here, Thursday, August 1st, you can see a massive dump across both indices occurred. This dump lasted several days, with Japan, the Nikkei, wiping out nearly 22% of valuation within 3 trading days. Looking at the S&P 500, we had a drop of 8% within 3 days. It was wild. I remember I was here for August. And at the time, I didn't know the carry trade dynamics. And I was just clueless. I was caught completely off guard. It was one of my biggest losses. And by day 2, I just kind of stayed out of it. I was like, fuck this. You know what I mean? But now I understand it. And I'm here trying to educate you guys a little bit about it. This happened rapidly because of the carry trade dynamics, the carry trade unwinding. All right. Similar thing happened over here on December 18th. Okay. December 18th, while it didn't happen as much over here, let me see this. December, I need to move this. 18th, yeah, right here. So on December 18th, again, the federal funds rate target was lowered by 25 basis points in the FOMC. Okay. Their meeting was December 17th to the 18th. And the Japanese, the Bank of Japan meeting ended on Thursday, December 19th. And they decided to keep its short-term interest rate target unchanged. All right. So the drop in US equities was larger than the drop in the Japanese equities, but nonetheless, there was a significant drop over here. This was also largely due to Powell giving very hawkish comments on the future of the economy, which is something that is on the table for today. We just don't know. However, this scenario right here where the Bank of Japan increased rates while the US lowered rates is exactly the same scenario we are going to see in this month of Federal Reserve meetings. Our Federal Reserve is lowering interest rates. The Bank of Japan is increasing interest rates. The meeting for the FOMC is today, and the Bank of Japan meeting is on December 18th. Okay, so it's almost even down to the same days, guys. And so this is something that's really worrying me right now. We have yields that are rising uncontrollably. All right, this means that there is sell pressure on US bonds. It's indisputable. You have gold and silver and commodities ripping face. Okay, this is a flight to safety. Risk on assets are getting decimated. Bitcoin, I'll just say right now, Bitcoin is not a flight to safety asset. Bitcoin is not a debasement trade. Bitcoin is a risk on trade well before it is a debasement trade. And how do you want to confirm that? Look at Bitcoin's behavior and performance this year compared to gold. Gold has had a ripper rally up like 70% on the year, while Bitcoin is down 3% on the year. Okay? This is in spite of massive inflation, in spite of lowering interest rate, in spite of a record high M2 money supply. What does that tell you? All these liquidity dynamics that Bitcoin bulls keep on incessantly talking about. Oh, inflation is rising. The dollar is devaluing. The money supply is increasing. Okay? The printing is not stopping. The train is not stopping, guys. But Bitcoin did. Why? Because Bitcoin is a risk-on asset, first and foremost. Gold is not. Gold is a flight to safety asset. It is a pure debasement trade, which is why gold is ripping, which is why silver is ripping, and Bitcoin is down in the shitter. And all these dynamics and context clues are telling me that we could have a massive unwinding in stocks and equities that could result in a drop very similar in both these equity classes, within the next month or so. This is not a prediction again, nor is this financial advice. As always, not financial advice, and I am just an amateur doing this because I enjoy it. I like learning and, want to grow this community and everything. But that is my take on it. It's something that we absolutely should be worried about. There's historical precedent. The similarities are evident. And it's just something that you should be cautious about. I don't want anyone, coming into comment section or, into the group and saying, damn, I got caught out of nowhere. Know the risk. Know the risk. Risk always arises when you don't know what you're doing. Thank you very much for watching. Have a great rest of your day.